given how strong our results are, I almost feel like we should just go home. But we've been saying since we went public in a DPO that we would build infrastructure to make America and its allies the dominant force in the world. We claimed to much skepticism that this would be done in a software product, that defense and commercial industry would be driven by software.
They can't increase operating margins much further.
That's the wrong answer. No.
It is not the wrong answer.
What? No.
Oh, we got some disagreement. All right, here we go.
Is when they reach a certain scale, the marginal effect of this, like the marginal cost of distributing something, literally goes to zero. So you can capture a lot of value while deploying very little resources.
These are the operating expenses associated with Palantir, and as you can see, there's a clear trend, and it's very clear why Palantir's operating expenses are more or less static or range bound, and it's not associated with increase of revenue. So typically, most companies would you would see increased spending in order to acquire an increased rate of revenue. That's not the case for Palantir. Their general and admin, more or less static. Their R&D, which surprised me actually, has been more or less static at 100 million for like 4 years. And during that time, we got a lot of new platforms. We got Warp Speed, AIP. I don't need to tell you. They've been doing a lot on the R&D segment. And it's more or less static. And the sales, you might have thought that, well, they're actually starting to accelerate revenue growth, so sales should be going up. Nope, sales is also decreasing. So you tell me, why would margin expansion stop here, Steve? Make the argument. Why can't Palantir increase their operating margins? Because I think there's like no end in sight in regards to how they will increase their operating margins. I think this will continue for a long time. So, and again, excuse my voice, I am sick. So.
Then no problem. So can you bring that back up, please?
The chart?
Yeah, and you gotta zoom in a little bit, Amir.
Yeah, sure.
Get a
I will try.
I couldn't read the words on it.
I think what Amir is trying to say is cost basis, or sorry, SG&A, and a lot of these things have kind of remained flat, and they've actually decreased employee count year over year.
So what this chart shows is the operating expenses as a percentage of revenues. So instead of just tracking the absolute amount, which is more or less static, if we put it in relation to the revenue, which actually translates directly to the operating margin, we can see that all their costs as a percentage of revenue are going down, and in return, you get this margin expansion. And it's been going on for a long while now, and I don't really see an end in sight for this, because they are operating, they are doing a lot of stuff, they are scaling, and there are no real costs associated with that, which is one of the black magic things about Palantir. They're doing so much, but not at an increased cost.
Sure. So yes, they are static at the moment, and revenue is going up, and they just recently became profitable. But as they continue to scale, they are most likely going to need to bring more things on. Can they stay at these levels or even decline? Sure, but it's likely that they won't. Maybe they can.
Why? Because that's the discussion here.
So R&D. R&D has been going up. R&D in the trailing 12 is $445 million. Last year was 404. The year before that, it was 359. Selling general admin is at 1.34 billion. Last year it was 1.27. Year before that, 1.29. So it is gradually going up as they expand. For cost of revenue this year, trailing 12, 500 million. Last year, 431. The year before that, 408. The cost of revenue, their R&D, and the selling general and admin have been going up year over year for the past several years. Now they're outpacing it with revenue. In order for them to keep these margins the same or have them continue to go down, they have to continue growing revenue at this rate. You have to believe that growing revenue at this rate is possible, or it's going to accelerate to keep that chart the way it's going. I can't predict that that's going to happen, but they're already operating at a gross pretty much where they're going to operate. They can't.
But why would you invest in Palantir if you don't think they're going to grow revenue, right?
But the growth will always stay the same for us.
I said that they have to continue growing revenue at this pace to keep that chart intact.
Yeah, 30%, right?
Which Do you
Like,
think
why
they're
would you
gonna
invest in
grow-
Palantir if you don't think they're going to grow 30%?
Do you think they're going to grow revenue at 30% year over year, year over year?
I
year over year?
have to believe that if I'm investing in this company.
Like we would see exactly what I actually shared like 2 years ago, but that's the essence of how a successful SaaS business works. Well, you have the operating expenses that are initially very, very high, but your business size is relatively small. So you end up having a negative free cash flow. But if you have a good engine behind the surface, when you scale, you're able to scale much faster than your cost. And this is true a lot for Palantir. We have been seeing that in the numbers. A couple of years ago, Palantir was burning cash. Now it is literally printing cash, while you have all these other software companies like Snowflake that pretend to be very scalable, but in reality, they're just adding a lot of employees over a lot of employees. And we don't really see this. Like we see this, but under like a very different shape. While with Palantir, this becomes very, very clear. The more it scales, the more the gross profit can grow much faster than the operating expenses, because that is the nature of tech. We have Amazon, sorry, not Amazon, exactly the wrong example. We have Apple.
Maybe it is Amazon. Who knows? Maybe. We have Microsoft that literally defy the gravity. But why? Because tech, by its essence, is do more with less. And the beautiful thing about these tech companies is when they reach a certain scale, the marginal effect of this, like the marginal cost of distributing something, literally goes to zero. So you can capture a lot of value while deploying very little resources. And we have been seeing this with Palantir as it today, right now. But I don't think we should exclude at all that Palantir's operating margin, so not talking the net profit margin, but at an operating level, can reach 50 or even 60, thanks to this dynamic. So Steve, this is the question to you then. Arnie's describing this growth lever of operating margins going up along with top line revenue growth, which is kind of why the rule of 40 was phenomenal at 68%. You and I talked after earnings and you were like, dude, I don't really care about this rule of 40 number. So what is it about that makes you scared?
I don't care about the rule of 40 number, because what you need to happen is for them to continue to beat on the top and bottom line every quarter, because that's what the headline is, unfortunately, not how great the business model is. And I am worried that as interest rates come down, Palantir's growth rate may not hold up, and we may miss on the bottom line. And if we do, it could cause very serious ramifications for the stock price.
So here's the question.
That is a real serious thing.
Go ahead, Arnie.
I also have a question. You are essentially saying that if interest rates go down, that would be a negative for the company. Like maybe it is totally true that if interest rates go down, the net income from the cash on interest decreases. That is absolutely true. But that completely forgets the business dynamic, which is if interest rates decrease, the net positive value, like the net present value of all IT projects becomes increasingly higher, which is exactly why during COVID, we had the boom of tech. Because
basically, are you saying rates come down, the market puts a premium to good companies that have growth?
Exactly that. Like now, the software business, like the software world, is still relatively stuck because all the companies were essentially spending a lot of money in IT projects because money was cheap. But what Palantir is doing is accelerating into this tough environment, which my bet is, okay, let's decrease the interest rates. Deploying Palantir becomes marginally cheaper. The business would triple in no time just because of that. So rather than being a headwind, I think that would be like the most phenomenal business tailwind Palantir could get if interest rates decrease.
Palantir's product isn't going to become cheaper. It's just going to become cheaper for companies to borrow to expand their business. So that's two separate things.
Well, the net present value, increases a lot.
Product does not become cheaper.
No, but businesses can afford Palantir if the cost of capital is cheaper. Which means more growth, baby. That's what I'm talking about. Like,
capital is cheaper, business expansion is more likely to occur. But that does not mean the price of Palantir's software is going to change. How many customers does Palantir have?
No, but the price doesn't have to change. But if they sell more of it,
does Palantir have?
629. But if they sell more of the software,
is that a lot of customers?
No, obviously not. No.
Okay, so for Palantir to hit these meteoric growth rates that we needed to hit, They have to get into small, medium-sized businesses. That's a fact. You're running out of companies. You can't assume, and I am a Palantir Super Bowl. Okay, I've been in the stock since the direct listing. I'm not bearish, but you're running out of large-scale companies that can adapt this. Not every company is going to use Palantir. They need to start getting small and medium-sized businesses also.
Well, Carp doesn't agree with that, at least not for now.
Okay.
Well, hold on. Carp did say, Matt, I want to get your thoughts on this as well. Carp said on the call, we don't want 10,000 customers. We want 1,000 of the best customers. I feel like he's serious about that. And that matters when it comes to sucking more revenue out of them versus just getting more customers mixed with the numbers. So what can we all say is a reason to justify 130 billion if you had to be an analyst on Wall Street that was like talking to your clients to justify this price to them for somehow to make sense of it? I have a theory in my head. Arnie, I want to start with you, but what could justify even 200 billion if we actually get there? That doesn't have to do with the numbers.
As a potential analyst, it would be hard, given the current numbers, to justify. It is already hard, this number, to justify it because it requires very strong assumptions. And to justify something even bigger, it would require further extreme assumptions, which seem very extreme given the past that we know. But that brings me to the second point. Like, as Arnie, my bet is that analysts still don't understand the company. So what makes me confident that we can go farther is the fact that analysts still are stuck to estimates that are well below the true potential that is emerging. And for instance, when we were talking previously about the multiples, the valuation multiples, yes, it is true, like that is important to have a reference given the estimates, but it seems that the estimates analysts are giving are destroyed by the quarter. So, So my bet as an investor is, okay, analysts are still wrong. Analysts still don't really understand what's going on. And until that doesn't happen, but smart investors are seeing that, and the business results are on our side, I still believe there is potential. Now, there is certainly a lot of interest, but I would argue that how many AI companies, pure software AI, there are now in the S&P 500? I know only one. And how much demand there is right now on that side, as from asset managers? I would argue a lot. So until there are no other alternatives, there is only one way asset managers need to expose themselves. And I don't remember if it was you, Emir, like credits to who said that, but we are approaching the end of the day, the end of the year. Asset managers can't show in their in their filings that they're not exposed to the big story that is emerging.
It's like if you didn't own Nvidia by July, you almost got fired as an asset manager.
You look stupid. Like, it's better to catch up like later, just to say, oh yeah, Nvidia, yes, of course we are exposed, even if they completely missed their head. I mean, that's how the asset manager industry work, like window dressing at best.